It is incredibly easy to take the modern financial system for granted.
Oh, absolutely.
Like you pull out your phone, you tap a sleekly designed little app to request a loan, and the money just appears in your account. The interface is completely frictionless.
Right, it feels effortless.
Yeah, almost like the money materializes out of thin air.
We are completely shielded from the actual machinery. I mean, the user experience is specifically designed to hide the thousands of calculations and massive transfers of capital happening in the background.
And if you look behind that frictionless screen, you are looking at a massive, highly optimized factory. So today, we are taking you right down to that factory floor.
Yep.
Welcome to this deep dive. We have an exclusive look under the hood of modern finance, and we're specifically using the first quarter 2026 earnings call Q&A from SoFi as our map today.
And earnings calls are fascinating because, well, that is where the polished consumer marketing is just stripped away. You have institutional analysts demanding to know exactly how the financial machine works, where the risks are buried, and if the operational gears are actually turning a profit.
Right. So our mission for you today is to decode how a giant fintech platform actually engineers its revenue, how it manages massive credit risks, and how it navigates accounting rules that, frankly, sound deliberately confusing to the outside world.
They really do.
Yeah. So whether you are prepping for a board meeting or analyzing market trends or just insanely curious about how banks are making money off your mortgage or personal loan, we are going to break down the actual mechanics.
No jargon left undefined.
Exactly. Just the operational reality.
And that operational reality, it always comes down to a fundamental tension.
Yeah.
We will see the highly specific choices a company's leadership makes every single day.
To balance grabbing short-term cash.
Exactly, balancing that short-term cash against ensuring long-term multi-year stability.
Okay, let's unpack this because we are starting with the most fundamental question any lender faces. Once they originate a loan, like once you tap that button and they wire you the funds, where does that debt actually go?
It's a great question.
During this Q&A, an analyst named Andrew Jeffrey asked CEO Anthony Noto a very pointed question about this. He essentially asked why the company's holding on to personal loans at all.
Right.
He was suggesting they should just sell everything immediately to maximize their fee income in the current economic environment.
And it is a really revealing question from the analyst because, in an uncertain macroeconomic environment, Wall Street generally prefers companies to stockpile cash immediately.
Makes sense.
So the analyst is essentially asking why SoFi doesn't just act as a pure middleman, taking a cut of the transaction and washing their hands of the borrower.
Right. But Noto's answer outlines a dual strategy that dictates their entire business model. He explained that a newly originated loan can travel down one of two paths.
Right, path number one.
Yeah, the first path is keeping the loan on their own balance sheet. To visualize this, think of the balance sheet path like buying a house to rent it out.
Okay, I like that.
You have to tie up your own capital to acquire it, and you carry all the ongoing risk.
If the water heater breaks, you pay for it.
Exactly. Or in this case, if the borrower defaults, you take the financial hit. But the upside is you secure a highly attractive, predictable stream of net interest income over the next 2 to 3 years.
Right, which is the traditional banking model at its core. You lend money, you collect interest over time.
Simple enough.
But Noto points out there is a hard mathematical limit to how much they can operate this way, and it's dictated by their capital ratios.
Oh, right, the regulators.
Yep. Regulators require financial institutions to hold a strict percentage of their own capital in reserve against the loans they hold. So they cannot lend infinitely.
Do they hit a wall?
Exactly. If they fill up their balance sheet with loans, they hit their regulatory ceiling and their ability to grow instantly stalls.
Which brings us to the second path, which is the loan platform business, or LPB. This is where that middleman strategy comes into play. Noto explained that routing a loan through the LPB requires zero of their own capital.
None at all.
And it carries no retained credit risk. Using our real estate analogy, the LPB model is like being a real estate broker or a house flipper.
Yes.
You facilitate the deal, package the paperwork, collect your cash up front, and walk away. If the roof caves in 3 months later, the new owner deals with it, not you.
Right, and Noto explicitly stated that the LPB volume functions as their overflow valve.
The overflow, yeah.
It is the destination for loans they wouldn't or couldn't put on their own balance sheet due to those strict capital limits we just talked about, or specific credit profiles, or simply to manage their overall balance sheet growth targets.
What's fascinating here is how explicit CEO Anthony Noto was. about this tension. He specifically told the analysts that they are purposely not trying to maximize near-term revenue.
Which analysts hate to hear,
Right.
usually.
Exactly. They are intentionally throttling the immediate cash flow they could get from that house-flipping LPB model just to ensure they build the long-term, multi-year rental income of the balance sheet loans.
It is a heavily engineered balancing act. I mean, think about it. If they only utilize the LPB, they would post a massive revenue number this quarter,
Right.
but they would have zero baseline income guaranteed for next year. And conversely, if they only held loans, they would hit their regulatory capital limits in a matter of months.
And the entire growth engine would just freeze.
Exactly. So they are actively managing the pipeline to feed both models simultaneously. They're optimizing for durability rather than just a quick quarterly pop.
But producing a massive overflow pipeline of loans through the LPB, it only works if there's a hungry buyer on the other end,
Yep.
right?
Oh, absolutely.
If you are flipping the risk, someone else has to be willing to catch it.
Right, and that requires us to look past the internal company strategy and examine the broader external market dynamics.
So CFO Chris Lapointe weighed in on the call to address the external demand for this LPB overflow. He described the appetite as extremely robust.
Very robust.
Every single existing partner whose contract came up for renewal has extended it. Furthermore, they just announced 3 brand new partnerships totaling $3.6 billion in purchase commitments over the next 2 years.
A $3.6 billion commitment is a massive institutional signal. Like, these are not small, speculative pilot programs.
No, not at all. And the capital is coming from heavy hitters, too. Large investment bank, a large asset management firm, and a major insurance fund.
Right.
Here's where it gets really interesting. Because if you look at the broader economic narrative right now, the headlines are completely dominated by inflation concerns and consumer financial stress.
Yep, it's everywhere.
Yet we have notoriously conservative institutions like insurance funds, eager to commit billions to buy up unsecured consumer debt.
It seems counterintuitive.
Right. If I'm running an insurance fund, my entire business model relies on generating safe, steady yield, so I have liquid cash to pay out future claims. So the fact that they view consumer personal loans as a safe harbor tells us something specific about the underlying borrowers.
It really does. It tells us that the institutional buyers are looking at the specific utility of these loans. On the call, Noto reported record originations in personal loans.
Right.
And he highlighted exactly what the funds are being used for refinancing expensive credit card debt.
Oh, okay.
Yeah, consumers are currently burdened by incredibly high-interest credit cards. So they're coming to the platform to secure a personal loan at a lower fixed interest rate to consolidate and pay off those revolving balances.
So the borrower is taking an active step to de-risk their own financial life. They're lowering their monthly payments and locking in a fixed rate, which drastically reduces their likelihood of defaulting.
Exactly.
That creates an extremely reliable asset class. The Main Street problem of expensive credit cards fuels the Main Street solution of a consolidation loan.
Which in turn creates the exact steady yield financial product that Wall Street institutions are just desperate to buy.
It is a complete self-sustaining ecosystem. The institutional capital provides the liquidity that allows the platform to offer the loan to the consumer in the first place.
Right.
And Noto also mentioned record originations in student loan refinancing. However, the operational detail that is truly disruptive is what they're doing with home loans.
Oh, this part was wild.
Yeah, Noto noted that their home loan business more than doubled year over year. But the truly staggering metric is their aggressive iteration on the technology side to reach a 10-day application-to-close process for new home purchases.
10 days.
10 days from clicking apply to receiving the keys.
Anyone who has purchased a home knows that the traditional mortgage process is archaic.
It's a nightmare.
Yeah, heavily manual, and typically takes 30 to 45 days. So shrinking that window to 10 days is a massive operational feat that requires deeply integrated automated underwriting.
And in a competitive real estate market, the downstream effects of a 10-day close are profound. It effectively turns a financed offer into the equivalent of an all-cash offer.
Yes, exactly.
It removes the financing contingency bottleneck that sellers hate. So the platform is using extreme operational speed as a unique value proposition to capture market share from traditional banks.
And that speed drives record consumer demand, which fills the origination pipeline, which then feeds right back into the $3.6 billion appetite of those asset managers and insurance funds.
Right.
The frictionless consumer experience directly powers the back-end institutional engine.
But processing that kind of explosive growth, shuttling billions of dollars from consumer applications to Wall Street balance sheets, that creates a massive secondary problem.
The accounting.
Right. How do you legally and accurately record that scale of movement on your financial statements without triggering regulatory alarms?
The accounting has to perfectly mirror the operational reality, and this is where the call got highly technical.
Very technical. The headline numbers look very strong. CFO Chris Lapointe provided guidance for 2026, projecting 30% top-line growth and 60 cents in earnings per share.
Okay.
He broke down the segment expectations, too. Lending revenue is projected to grow at least 30%, financial services by at least 40%. The tech platform revenue should hit around $325 million, while corporate revenue will stay flat compared to 2025.
Those are solid numbers.
They are. But an analyst named Kyle Joseph basically bypassed the headline growth and started digging into the accounting mechanics. Specifically, he was questioning how the company handles marketing expenses.
And this is a crucial element of corporate reporting.
Right. So Lapointe explained that for their money and invest members, meaning the users utilizing their banking and investment products, they often acquire them through third-party marketing channels.
Okay.
They pay a success-based commission when a new revenue-generating member signs up. But instead of recording that commission as an immediate expense, Lapointe stated they utilize an accounting rule known as ASC 34040.
ASC 34040.
Yes, they classify these as contract acquisition costs.
Right, and the source material explicitly defines the mechanism they use here. They capitalize those costs and amortize them over the expected life of the member.
Okay, let's pause there.
Sure, well, amortization is the accounting process of gradually writing off the initial cost of an asset over its useful life.
So what does this all mean? Because I have to act as the skeptic for you here.
Go for it.
When a company talks about capitalizing marketing expenses instead of simply taking the hit today, it sounds highly suspicious.
It sounds like a trick.
Exactly. It sounds like a strategic accounting maneuver designed to hide current expenses, artificially inflate quarterly profits, and make that 60 cents in earnings per share look achievable.
I get that. But if we connect this to the broader principles of corporate finance, it is actually the foundation of accurate reporting. It relies on the matching principle.
The matching principle.
Right. Consider a physical manufacturing business. If a company spends $100 million to build a factory that will produce goods for the next 20 years, they are not allowed to record a $100 million loss on day one.
Because that would skew the numbers.
Exactly. Doing so would make their current quarter look disastrously unprofitable and their future quarters look artificially lucrative because the factory would essentially be operating for free.
Makes sense.
Instead, they depreciate the cost of that factory over its 20-year useful life, matching the expense of the building to the revenue it generates year by year.
Okay, wait, I have to challenge that comparison.
Okay.
A factory is a physical, tangible asset. If the manufacturing business goes bankrupt, the creditors can step in, seize the facility, and sell the heavy machinery to recoup their losses.
Sure.
You cannot liquidate a marketing expense. If a newly acquired user closes their account in month 2, there is no asset to sell. So how do strict corporate auditors actually allow a company to treat an intangible customer sign-up like a physical piece of real estate?
That is a fair point, and it comes down to actuarial data. To use ASC 34040, a company has to prove to their auditors, using vast amounts of historical data, that an acquired member has a highly predictable lifespan.
They need proof.
Exactly. They have to prove that this user will generate a highly predictable stream of revenue, like debit interchange fees or brokerage commissions. Once the auditors agree the data proves the user is effectively a reliable revenue-generating asset, the company is required to match the acquisition cost to that revenue timeline.
Oh, I see.
So if they pay a commission to acquire a member who historical data proves will trade stocks for the next 5 years, they amortize that cost over 5 years.
Okay, that makes more sense.
Furthermore, Lapointe explicitly clarified that this accounting treatment does not hide the expense. The amortization still hits their net income and their EBITDA.
Which is their earnings before interest, taxes, depreciation, and amortization.
Right, which is the core metric of their operational profitability. So the expense is fully recognized. It is simply recognized on a schedule that mirrors the incoming revenue.
So the expense hits the ledger exactly when the revenue hits the ledger. That neutralizes the skepticism regarding inflated profits, as the auditors demand historical proof of the user's lifespan before allowing the amortization.
Exactly.
But there was another Even more complex accounting maneuver discussed regarding a massive loan sale executed in September.
Yes, the analyst questioned a transaction involving JP Morgan and a special purpose entity, or SPE.
Right. Lapointe detailed that they opportunistically sold a portfolio of loans to JP Morgan.
Huh.
However, they didn't just wire the assets over. They established an SPE, which is a completely separate corporate shell.
Okay.
JP Morgan took the controlling interest in this entity. For SoFi to legally clear those loans from their books, they had to secure a true sale opinion from an independent third-party legal firm.
A true sale opinion.
Yes, this opinion certified that the transaction met the strict standards of GAAP, generally accepted accounting principles, to achieve something called legal isolation.
And legal isolation is the critical mechanism in this transaction. You see, in the history of finance, regulators have seen companies, quote unquote, sell toxic assets to partner firms to make their balance sheets look clean.
Right, but secretly keeping them.
Exactly, secretly holding an agreement to buy the assets back if they default, so the risk never actually left the building.
So the true sale opinion proves there are no secret agreements.
Yeah.
It creates a permanent, legally binding firewall.
Yep.
If the specific consumer loans bundle into that special purpose entity, suddenly default en masse and go to zero, the losses are entirely trapped inside that shell company.
JP Morgan absorbs the hit.
Exactly. JP Morgan absorbs the hit, and they have absolutely no legal recourse to pierce the corporate veil and demand a refund from SoFi.
Because that liability is completely severed, accounting rules allow SoFi to de-recognize the assets. They wipe the loans completely off their financial statement.
Which circles us right back to the very beginning of the deep dive. De-recognizing those loans empties their balance sheet.
Right.
It frees up the strict capital ratios we discussed earlier, giving them the regulatory clearance to instantly start originating new loans and collecting new upfront cash.
It's brilliant.
The ecosystem is a perfectly closed, infinitely repeatable loop. They originate loans, selectively filter the overflow into the LPB, utilize special purpose entities to legally scrub the risk off their books, and use the freed up capital to fund the next 10-day mortgage.
You are seeing exactly how the factory floor operates. Every variable is aggressively optimized.
So, bringing all of this together, why does understanding this machinery matter to you? It matters because whether you are building a stock portfolio, running your own business, and trying to navigate cash flow versus long-term strategy, or if you are simply a consumer applying for a home loan, understanding these underlying mechanics gives you a significant informational edge.
It really does.
You now know that behind every single frictionless loan approval, there isn't just a local banker stamping a document. There is a deeply complex, hyper-optimized web of regulatory capital limits, billions of dollars from Wall Street institutional buyers, and strategic corporate accounting decisions dictating exactly where your debt ends up.
It fundamentally changes how you view the financial ecosystem. And, this raises an important question for you to mull over as we wrap up today's analysis.
Yeah.
If a massive financial platform is actively utilizing algorithms to decide in a fraction of a second whether to hold your debt for years or instantly package it into a legally isolated shell company to be sold off to an insurance fund, well, what does that say about the future of traditional banking?
Are we rapidly moving toward a world where the institution you borrow your money from, like the recognizable logo sitting on your phone, is never actually the entity holding your debt?
And if your local bank is increasingly just a frictionless digital storefront for a faceless global asset manager who is really in control of the modern economy, something to think about the next time you tap that little button on your screen. Thanks for joining us, and we will see you on the next deep dive.